Yo, what's good? It's Jbandz. Today I'm going to be giving you the ultimate guide to multi-yellow box chart. As a beginner, I know looking at all these different components and colors can be overwhelming, so hopefully me explaining what every single thing means is going to be helpful to you and show you how to trade it more. So first we can go start off with the volatility metrics. So we have average range, max range, yellow box, average range, max range, and max trend. So in the fractal system, I'll just give a brief overview. There's other videos that go into it more in detail. So option analyzer, wave 7, 50 days to load, 60-minute candles. Today's close, unlock mouse tracking, maximize it, go to the current. So the max range, this yellow box, each one of these candles represents a 60-minute time period and the high and the low of it. And if it was a bullish candle, bearish candle, and the open and the close of it. So this yellow box signifies where 70% of the candles remain within 70% of the 60-minute candles based off of extension, not actual price, since it's a fractal graph, not a linear graph. So the max range is when we break the yellow box, what's the max candle we went, right? So this one. And the average range is going to be when we break the yellow box, where do we get to 50% of the time for continuation, and we revert 50% of the time. So you just want to see where it tests the top of the most candles. So it would be around this area. That's the average range. And then up here is the max trend. So looking here at Milk's chart, breaking the yellow box, that can just signify directionality. The average ranges, we already know that according to that tool, 50% of the time we continue, 50% of the time we reject. So they could be caps to small moves in low volatility, and if we break it, then signaling more continuation. And they tend to be very supportive and resistive. And as well as we know when we break it, support turns to resistance, right? So we had minor support, sellers were strong, and then turns to resistance, and then support when we break it. And it can signal more continuation once we break it. So as we can see, support, support, resistance, yeah. And obviously not every single test it's going to be support or resisted because it's only a 50% probability, but it's great with confluence and confirmation. Then we have max range days. So this is where we expect the maximum extension of volatility to be on our typical range day. And then once we break it, it could signal more trend. So as you see, we broke it and then signal more trend to come. And it tends to be very supportive and resistive. So as we can see, this is sort of the last line of defense on this tool from a volatility standpoint of where we're going to have a trend line if we break. So as we can see, we get here almost exactly to the tick, we support, and then sellers are still strong. They want to take it further. So they break it, they break max range, and then retest support turns to resistance when it's broken. And then we have much more continuation to come. So the next thing I'm going to explain is spread monster, right? So another tool in fractals, you go to ES, wave 1 daily, spread monster. So what this graph is showing, give a brief overview. There's going to be more in-depth explanations in another video. So in the last 200 days to load, we only had 5 occurrences that met this specific volatility classification based off of underlying geometrical patterns and highs and lows made on that day. So as we could see yesterday, this was a very atypical movement, and we don't get that every day. In the past 200 days, we only had 5 total that met this volatility classification. So this chart is then computed based off of probabilities and odds given that data set. So based on this 5 days in the sample, this white line right here, this is called the apex, right? So this is essentially the neutral point. It's essentially a pivot, but on the spread monster graph. So it's saying buyers are in control above, sellers are in control below, so bullish above, bearish below. and it's the point of contention and for directionality as well. So if we go here, we could see these apexes, right? And like I said, they're pivots, right? So bullish above, bearish below. So they tend to be very supportive and resistive, especially in low volatility conditions such as extended trading hours, ETH, and they signal directionality as well as strong support and resistance. And they also tend to be a very strong confluence. As we can see here, we had a ton of different confluences here: order flow, volatility metrics, spread monster, and it played beautifully. As well as yesterday, we had order flow, historical order flow zone, and with spread monster as well. Beautiful, almost to the tick. And then next we can go over IV walls. So this is IV wall, stands for implied volatility. And this is the range where market makers make money within. And I'll show a quick overview of how we derive that. So we go into, you need an accompanying options market. It doesn't work for futures. It's just converted from futures until it's converted from options to futures. And actually the options chain hasn't been removed yet, so I need to pull up a picture. So here we have a picture of what you'll be looking at, and I'll show you how to get there. So you go to SPX Wave 1 Daily, Spread Monster, Show Strikes, and then select the expiry date. So view density graph, maximize. But as you could see, it's all out of whack because the previous day's options chain hasn't updated. It hasn't been deleted, and the next day's hasn't updated yet, right? So this is what it typically looks like. And we could see where market makers are making money, and where they want price to maintain within based off the way they price out the different option contracts in the options chain. So we have these strikes on the side. It says each strike, and we can tell where they're making the most money and where they make money within based off the curvature of the convexes. So this is flat here. This is the curvature of the convex. And so where it flattens out is where the IV wall is, where they need to maintain price within to be making money. So as you can see from Milk's chart, he has 3 different lines on the IV wall. So the IV wall, the IV underperformance, and the IV overflow. So the IV underperformance is the closest line that has a minimal white gap. You see that very small white gap. And then the IV wall's next one below it. It converges onto it, no gap. And then the IV overflow is the next one. So what this is saying is just where market maker, the range, right? The predetermined range on the day that we get before the day even starts, where we know market makers want to keep price within because that's where they're making money. And when we exit and enter a positive exposure move, they have to start hedging their positions, which they don't like to do, which can exacerbate an even further positive exposure move. So these tend to work very good as support and resistance, caps of sessions, always pending outliers. Nothing is an absolute, like as we can see. Once we got past it in this positive exposure move, it was signaling a massive positive exposure move to come. And then sort of like a squeeze setup in a sense that market makers had to start hedging their positions, which just was like a snowball effect into the move. And as we could see, yeah, they tend to be caps of sessions in confluence with other things. And then we know that resistance, once broken, turns into support, right? So the retest, and then more continuation for the positive exposure move. And then this yellow box, This is the point of control. So this is where the most volume was conducted from 24 to 26. And you can see because we spent a lot of time in this range. So since there was so much volume conducted, it is very significant. It shows sentiment that that is where the most fair value is perceived, since there was those people market buying and market selling in that price range, because market buyers want to market buy because they think fair value is higher, and market sellers want to sell because they think price is lower. So this ends up being an intraday MGI, which is just means market generated information. So a live time pivot, and because it's also a target, right? So where um, buyers and sellers, market participants mutually agree that the most fair value is, right? So if that's where fair value is, we want to get back there. And it's also a pivot because since so many people market bought here as well as market sold here, that once we maintain above, we're gonna be bullish, and once we get below, we're gonna be bearish. And then when you see the green number with the negative delta, then that's seller absorption. So sellers were putting in effort here, as you could see. And obviously, with the rule of three, the more tests we make on a range, we expect it to break. So as you see, it was initially very sportive, and then the more times we tested it, obviously, eventually we're going to break through. But on the initial tests, it's very telling that sellers were putting in much more effort here, but not getting rewarded. Therefore, they were force covered. So they were forced to buy to close their positions. And with no new initiative sellers, since they were had to buy to close and cover their positions, along with new initiative buyers coming in, that leads to a squeeze setup. No matter how macro or micro it is, that's just the conventions of it. And then next we can talk about single prints. So these purple lines, these purple boxes on, all right, right? So we have these purple boxes that auto-populate on the chart, right? So these come from a TPO graph, time price opportunity. And what these are signifying are fair value in the market. So what this is actually technically saying is that we didn't spend a lot of time in this given range, right? So we spent less than a 30-minute, we spent only 30 minutes or less in this period. So what that's signifying is that since we didn't spend a lot of time in this period, it shows that there's not a lot of interest in auctioning in this period, since these market buyers didn't try hard to cap it off and buy higher. They just, essentially took off their orders and just agreed that this wouldn't be a good time to buy because they don't assess fair value to be higher. Fair value is the agreed upon value or price of an asset. So in this case, ES, where people think market participants agree that it is the most fitting value for this asset. So in this range, market buyers didn't think that it was up here, the correct price of ES, SP 500 futures. They thought that it was lower. So why would you buy if you think that it's lower? That would just be losing money. So they let market sellers sell through here, and that's just how this was created, because there's not a lot of time spent in here. And so now we know certain conventions. So first of all, just in the creation of it, just signals more continuation, because it just signals that fair value is so much lower. And then conventions of it, we know that on the first retest of it, it tends to be very supportive and resistive. So let me give you an example. Well, first of all, just on the ones that are created in the day, it's just very good continuation, right? So it it auto disappears as we auction in it, right? So it could have been down to here, and then as we went here, the first test resistive for more continuation. And then as you see here again, we created this, and then resistive for more continuation. And let me show one that was created on a previous day instead of Um, this is the same one as created on this day, resistive for more continuation, but I want to show one that was created on a day before. All right, so right here, you can see that on this day, we created this single print going up. We didn't spend 30 minutes here. Same conventions as I just described, but opposite. Buyers were strong this time and sellers didn't want to market sell. And so on the next day, we know certain conventions of it. We know that the first tests are going to be very supportive and resistive. One of the most powerful tools out there, in my opinion. And the auction market theory reasoning why is because since buyers and sellers mutually agreed that fair value is higher before, let's say here, it doesn't matter, just higher than here, that once we come back down, it's essentially like buyers buying at a discount price, knowing that they can make profit since fair value was agreed upon to be higher. So we have supportive, 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 and then eventually we're going to want to fill it. The reason why we're going to want to fill it, their targets for a pair, is because it's weak market structure. Buyers and sellers, well, since it's weak market structure, we know that the market is very efficient in repairing itself. So eventually, this is a target that sellers are going to want to repair and they're going to want to fill it completely, which they did, even though on the first couple of tests, like I said, the conventions are that it's supportive. So that's just both conventions right there, essentially. And same with the opposite, right? So we created this on this day, and because fair value gap was perceived to be lower previously, once we get up, sellers are essentially just going to sell at a premium. It's essentially just the opposite. They know they can sell high and buy back low here and just make money. So the conventions are all the same. And now time for my favorite zones, the ones that I use the most and which are the most powerful in my eyes, the historical order flow zones. So we have seller's objective, non-fair value, buyer positioning, pivot, secondary pivot, buyer's objective, seller positioning, etc. Those are the main ones. So you can think of it as what happened in the past at these specific prices. So, like what the different sentiment and the different effort was. And these are very telling for the future because they show where buyers want to take price to. That's what the objective is. Where sellers are ready to come step in, where they're very strong and want and have a lot of interest in selling there. And I'll tell you how we derive all of them. So you could think of it sort of like this signifying effort, these deltas on the side signifying effort, right? So we have tools that show us how much effort buyers put in historically at the last, or yeah, just when we were recently in this price range. So what buyer positioning and buyer's objective, those are derived the same way. Buyers put a lot of effort in these zones historically and yeah, previously. And so why these are very significant is buyer positioning, right? So buyers market bought a lot more times in here. They have a lot of interest in market buying here. Therefore, they're going to want to defend this price and this range because obviously since they've bought a lot here that they think fair value is higher. So on revisit, it's going to be very supportive because we expect buyers to aggressively step in and take price higher. It's where they're very well positioned in a sense that they've had historical interest and sentiment that they've bought a lot here. So they're going to want to defend that price. And buyer's objective is derived the same way where buyers put a lot of effort here, right? So since it's above price, it's buyer's objective. If it's below price, it's buyer positioning. And why that is because okay, buyers put a lot of effort in this price historically, therefore shows they have a lot of interest in buying there. Therefore, they want to recapture and reclaim above it since they think fair value is higher and they put a lot of effort, right? So it's all relative how much effort they put in that is a lot, right? Like 4,000 versus 1,000, right? So this is relatively a lot of effort that they put in. Otherwise, every price would be marked out blue or red since there's always going to be more effort in some places. So let's look for buyer's objective. Okay. We have this buyer's objective, right? So it's a target that buyers going to take price to and eventually want to reclaim above. Here they didn't reclaim above it, and here we did. And this one was the cap of session. And so the reason why buyer's objective is typically like you wouldn't expect if there's a high effort of buyers in this, you wouldn't expect it to be resisted, right? You'd expect them to just claim above. But the reason why is because that's a point of contention. We know that there's two sides to every market order. So with the buyers putting in a lot of market orders and aggression, the sellers also tried hard to passively absorb them and cap the move. So therefore, shows a lot of passive seller sentiment as well, and vice versa. So they typically tend to be resistive on first attempts because that's the passive participants, the sellers on the limit order book, trying to passively absorb them on first attempts. And sellers' positioning and objective are the same. It's where sellers put in a lot of effort historically and previously, saying that, okay, the market sold a lot more than market buyers bought here, signifying they have a lot of effort in and a lot of interest in selling at this price. So it's an objective, it's a target they want to reclaim. So if sellers are strong, where are they going to want to take price to? It gives us targets and metrics of where if sellers are strong, where do they want to take price to, right? So this is their objective. Eventually they're going to want to reclaim that as they did as they were very strong today. And why? Because they previously sold a lot in this area, signifying their interest in selling, and eventually they want to reclaim below it since they think that fair value is lower. And seller positioning, that's the opposite. That's just saying right here where it's the same exact thing but above price. So since they put in a lot of effort here previously, shows that they're positioned very well and that once price gets back, they're going to try hard to to passively defend this price since they're going to step in aggressively thinking that this is a really good price to sell and that they can make profit by it going lower. And then we have pivot and secondary pivot. So these are derived from the most significant, usually from the most significant things on the day before. So the two most significant data points, right? So effort put in, either buyers or sellers. And these are, like I said, sort of like the line in the sand, the neutral point between buyers and sellers, where buyers are in control above and sellers are in control below. So you can't see the stock candlesticks, but on specific tools, it shows us how much effort people actually put in different ranges. And just pressing extend on the previous day, you could see that these two were the pivotal points of the day. Even if you don't know the actual effort conducted there, you could still just see that it makes sense. So then going into the day, for today, based off the data from yesterday, we know that buyers are control above and sellers are control below, bullish above, bearish below. And so you could play these sort of like a zone once we're above the pivot and the secondary pivot. There's not always a secondary pivot. See, here we just have a pivot. And this tends to be very supportive and resistive. So you could play this as a zone. Once we're above, we're overall bullish. Once we're below, we're overall bearish. And sellers are control below, buyers are control above. And these tend to be very supportive and resistive. So as you can see on first tests, resistive, and then sellers were below on the retest, resistive, sellers in control. So those are some of the strongest tools every single day. Every single day, there's some sort of plays off of it usually that are very good. In confluence, of course, but these zones are always very, very clean and very telling, as you can see. And then the last one, my personal favorite, non-fair value. What that's saying is essentially a fair value gap. And it's exactly the same mechanics and reasonings as the single print that I said. It's just derived differently. So this single print is based off of time. And first of all, this one's also live populated, but for like this one historically, which was already here prior to the day, and this one, which was derived from previous sentiment, previous effort in this area, whereas this one was created from today. Um, and you'll see probably in the future that there will be a non-fair value zone on this. They usually tend to correlate and overlap a lot because when there's not a lot of time, well, first of all, the way that you derive these, so these are time-based fair value gaps, not a lot of time spent. These are volume-based fair value gaps. So we can see that there's not a lot of volume spent in this range from 76 to 84 historically. And we can extend left and see what actually happened there, right? So it makes sense, right? So it was resistive, not a lot of fair value in this zone. And then we basically just go straight above it and we don't auction in this specific range, signifying that there was not a lot of volume placed in here. And what does that tell you? That since there's not a lot of volume, there's not a lot of interest of auctioning in this specific range. And what is that saying? Well, since it didn't take a lot of volume to get through it, then the passive participants and both market participants, the aggressors and the passers, agree that market uh, fair va- fair value in the market is much higher or much lower because the passive people didn't try to cap it. They didn't attempt even to cap the move, and they agreed that fair value was hot, much higher previously. And same for this one as well, all the non-fair value zones. And these also, same conventions, tend to be very support and resistive. First tests are going to be discount buys for macro buyers. And then on the retest, they also tend to be very resistive on the first retest. Um, and obviously they're not absolutes. The strongest plays are when you pair all of these different data together while also reading the actual live sentiment, what's happening. They, the strongest positions are where you have the confirmation based off of the live data, which typically happens because let's say here, buyer positioning, right? Um, like just for example, that okay, buyers put in a lot of effort here historically, right? So buyers are going to want to step in aggressively to maintain it and defend it because they have a lot of interest in buying here. They think that price is fair value is higher. So you could see some correlation of just aggressive buyers stepping in with a positive delta. So that would just correlate with it, and same vice versa. And back to my point about non-fair value, just that they typically tend to correlate because where there's not a lot of time spent, there's typically also not a lot of value spent or volume conducted. But it's not an absolute, of course, and they do tend to be different. Yep, that about wraps everything up. I hope that helped, and feel free to ask me any questions. See ya.